All right. Good afternoon, everybody. Thanks for joining us for another edition of the Wealth and Wellness webinar with Lena and Claudia. I'm Claudia Glover. I'm an advisor and chair of the investment committee at BFG, and I'm joined by Lena Nebel, our president and chief operating officer. Last time we got together, I was in the hot seat taking questions on investments, and today we get to switch places. Lena's going to be in the hot seat.
Very
Today's topic is quite fitting for a rainy day here. We're going to talk about insurance. So let's get started and explore all of the different ways that insurance can help to protect your wealth and your wellness. Lena, do you want to kick it off and get us started on why insurance is important?
sure. And I think we need some type of, musical interlude as we're, coming in and everything to kind of welcome everybody. But as Claudia mentioned, this is our part of a webinar series her and I do, and she definitely was in the hot seat on the last one because it was all things investment. So if you haven't had a chance to watch it, please go back to our BFG library and take a look at it. And so we decided it was my turn. So she's gonna ask me things about insurance. So we'll see if I'm able to answer. If you want to go back one slide though, just to kind of go through the agenda so everyone knows what we're going to be covering. So we're going to kind of hit all things insurance that we can think of, and probably some things we didn't think of either that will come up through conversation. Claudia and I meet with a lot of advisors, a lot of clients, and know the various topics that come up. So we're going to hit life insurance, health insurance, long-term care, disability, your property and auto policies, homeowners umbrella, and then just other things that we think of. So if you want to go to the next one, also as a reminder, any questions you have, please put them in the chat box. I know Claudia's has a lot for me, but if you guys think of anything, please put them there. Sarah's monitoring all the questions, and at the end, we'll hopefully have some time where we can answer a few. So, to answer your question, Claudia, why does insurance matter? Well, here's a few bullet points, as it relates to financial protection and peace of mind. Obviously, we've had situations, and we'll talk about some examples today of scenarios where clients, families have had some significant issues to where it was a loss of a loved one. It was maybe some car damage, house damage, and needed to be able to leverage that insurance. That's the financial protection so that you don't have to go into your savings and to your nest egg, that you've been paying on a policy that will pay out to assist with these costs. So, first and foremost, it's that financial protection and peace of mind. It mitigates the risk and uncertainty. All of the what if scenarios. What if I get sick and I can't continue to work? What happens to my income? What happens if my spouse passes away? How do I replace his or her income? So, by transferring the risk to the insurance company, that provides a little bit more certainty about what could happen in those what if scenarios. Safeguarding assets and income. For many people, they've spent their lifetime building up assets, generating higher income, and you want to make sure that that's protected. So, you don't want to have to stop working in the event that something happens to you where you need insurance, or take distributions from investments that could cause adverse tax consequences as well. So that's the beauty of having those insurance policies in place. And then insurance can also support estate planning and long term care needs, which we'll definitely spend some time in going through. There's a lot that's on the table for estate planning changes, state tax law changes. Insurance can help to provide liquidity to the estate. It can replenish inheritances to the heirs if that's a goal for many individuals. So, life insurance can provide some of those features, and we'll talk a little bit about that. And then, of course, in the event there's some type of long term care need, there's insurance that can help to support that as well. So, we'll kind of get into all these different scenarios through the course of this webinar.
That's perfect. Thanks, Lena. Why don't we go to the next slide and let's talk about life insurance to kick it off. Life insurance can be used for a number of different things, and typically is paying out to beneficiaries after somebody passes away. So Lena, why don't you give us an overview on life insurance? But then why don't we talk about some, common maybe misunderstandings? I hear a lot of times from younger clients that they're young and they're single and they don't need life insurance. What do you tell to clients like that? And how does that change if you're talking to a young family or somebody kind of nearing retirement?
Yeah, so I would say as a disclaimer across the board is that insurance may not be for everybody. There's some that need it, and there's honestly some that don't. And each situation is going to be different on their circumstances, their health, their financial needs, and their goals. So I can provide some kind of general comments or general answers to those questions, but I think it is as just a blanket disclaimer. You always want to talk to a professional, whether it's your financial advisor, your insurance agent, somebody who can really dive into your particular situation. So, in starting with kind of the younger clients, we obviously hear that a lot. Maybe they'll think, well, I'm not married, or I don't have children, or I don't have debt yet. Maybe I don't need the insurance right now. And that could absolutely be the case. But at the same time, buying the insurance when they're younger could provide some financial savings for them in the future because they can purchase the insurance now at a reduced rate because they could be healthier than they would be maybe in 5 or 10 years. They're also younger, but there has to be a need for that insurance. So, traditionally, at that age, you're basically protecting the income. So for many younger clients, maybe they just starting out their financial future with their spouse, then you're protecting that income. Maybe they want to have children down the road, then they could be protecting future education needs. And so buying it at a younger age when maybe they're planning ahead and don't necessarily need it right at this moment could be a possible benefit for them. For retirees, or I would say for individuals that are getting older, it's important to reassess your insurance needs every year. So, some of the things that we look at is we may decide to have some type of laddered insurance strategy to where maybe I need a lot of insurance my first 10 years while the kids are young. I still have my mortgage and I'm not making as much an income as I am in 20 years or 30 years out. So, maybe in 20 years, I have a lower amount of life insurance, and in 30 years I could even have less amount in life insurance because my debt is being reduced. I'm building up more savings. The kids' education is taken care of. So retirees may still have a need for insurance. It just may not be as much. One of the strategies that we tend to look at a lot for retirees, or I would say pre retirees, is what if one spouse has a pension? What if one spouse has higher Social Security income, or we need both Social Securities to be able to maintain the retirement lifestyle? Insurance can be used for maximizing those benefits. So that's a very common strategy to where you can maximize that pension so that in the event that the individual that is receiving that pension predeceases their spouse, and now that pension has gone away because they didn't choose a survivor benefit, we can replace that pension with life insurance. And so the same thing holds true with Social Security. So for some individuals, that may make sense as they get older. A lot of individuals also, one of the misconceptions, and I would say this is with every insurance, maybe just not life insurance. And I think this is why this webinar is super important, but also one of those topics nobody likes to talk about because it's insurance. And I think one of the things, Claudia, that you and I hear a lot is, well, what if the insurance company doesn't pay? I pay all this money and they don't even give me, they don't process my claim. So that's why it is important to look at the financial strength of the company, make sure that they are highly rated. They've been around for a long time so that they have a high claims paying ability so that you don't have that risk whatsoever. So life insurance for any age can be super beneficial.
That's great, Lena. And what if we start thinking about legacy giving or estate planning? There are some ways to use life insurance there as well, maybe on a more permanent basis for clients that have those types of goals. Why don't you walk us through some of those examples and how that could be used?
Sure. So I'll give you a personal example. I have 3 children, And for each child, we decided to purchase a whole life policy on their life, which for some individuals, they may think that's, well, that's kind of morbid, Lena. Why would you put life insurance on your kids? One, in the horrific event that something should happen to them, then I have an income. I have income that would be able to pay for those funeral expenses. That's not why I did it, but for some individuals, they need that type of policy in that type of event. And unfortunately, we've seen everything. So I know all those worst case scenarios and how they actually come true. But how we did it, which kind of ties into your question, talks about legacy planning. I wanted to make sure that I've protected my children's insurability, and I wanted to make sure that I would be able to pass off an asset to them in a tax efficient manner. So, as an example, we purchase whole life policies for each child. And so they are permanent policies to where they will have this insurance for the rest of their life as long as, we continue to make premiums based upon the time period that we're supposed to make premiums based on the contract. And so if something happens to one of my children to where they develop a particular disease, which again, personal story, one of my children did, to where we have risks now that she may no longer qualify for any type of insurance when she's an adult. She will always have this type of life insurance for her, and that she would be able to use that for her family to where she can make her family a beneficiary of that policy. So, one, we were able to protect insurability because when they're young, you have no idea what's going to develop over their lifetime. So we wanted to take care of that. And then, two, from a legacy standpoint, over time, I can make the decision if I want to transfer ownership of this policy to any of my children to where they would be able to use it for starting a business, purchasing a home, getting married, because there's cash value associated to that policy. So, for certain parents or grandparents, this is a great technique to use from a tax efficiency standpoint, for legacy planning. And then from an estate planning perspective, life insurance is tax free when received. So for some individuals, they want to be able to enhance their legacy, their inheritance, and that is a way in which they can do it by creating some life insurance death benefits to their heirs, and those can be received in a much more favorable way than, let's say, IRA assets.
That's a great point, Lena. And something that we've been looking at for clients is for those that may not need the IRA assets for income. We're looking at strategies to use those towards life insurance premiums to maybe leave behind a more tax efficient asset for their beneficiaries. So, really good point. Um, Great. I think we could talk about life insurance, really the whole webinar. But why don't we move on so we can make sure we cover everything? Sarah, if yeah, we did kind of touch on the types of life insurance there. We'll skip right past that, but let's switch to health insurance. So this is something that people deal with every day, that they have through a lot of times their employers, both spouses if they're working have access to it. But why don't you go over the important things with health insurance, what people should be looking at, maybe some of the differences between a high deductible health plan and the benefits there versus a PPO and what that might be.
Sure. If Sarah, you want to go to the next slide, I think we have the different ones. So a lot of people don't realize all the different types of plans that are out there. It can be very daunting. So when you think about your open enrollment, and there's all these different plans, sometimes people just look at, well, how much does it cost me, and let's just do that. And that's not necessarily the best way to examine your health insurance options. But just to give kind of a quick summary on the different types of plans, you have your HMO which is a health maintenance organization plan. It tends to have lower premiums, but the big thing about this one is you always need referrals. So when you're getting an HMO, you always have to have a referral to get into another doctor. So there's limited flexibility. A PPO has the most flexibility. There's no referrals that are needed, and you can usually go in network and out of network compared to the EPO, which is the exclusive provider organization. You don't see a lot of these, but they're out there. This does have a lower cost than traditionally your PPO, but there's no out of network available. So because of the limited flexibility, that's why you don't see a lot of these. And then lastly, there's the POS, which is the point of service. Again, you need referrals for this one. It tends to have a little bit of a higher premium, and you can go both in network and out of network. So the other type of plan that can be part of all four of these is a high deductible health plan. So within, let's say, a PPO, you could have a high deductible health plan, which would then give you the opportunity to get into a health savings account. A health savings account is a way in which you can put money into a plan. There's certain limits each year, and it's different based upon if you're an individual versus a family. But that money goes in pre tax. You have until April 15th of the following year to make the contribution for the prior year. And that money grows completely tax free if used for health related expenses, copays, prescription costs, deductibles. So for a high deductible health plan, the initial intention of the HSA was you start putting money into your HSA account to help you pay for that higher deductible. However, there's a few key characteristics of the HSA that would allow individuals to really leverage the tax-free nature of the HSA. You could actually do a one-time IRA rollover into the HSA to basically kickstart it. It's a non-taxable event. It's a lifetime rollover, so you only get one. And that money would be invested because you do have investment options available to you. Any contributions that you make into the HSA can be invested. And unlike a flexible savings account, this can be rolled over each year. So it is not a use it or lose it plan. So, assuming that you continue to make contributions each year, you invest it, think about this as a Roth account for health related items. So, when you're retired, you now have this HSA that has a healthy amount of assets in it that you can draw tax free for health related expenses. Well, I know when I'm retired, I'm going to have health insurance premiums, I'm going to have prescription costs, I'm going to have copays, I'm going to need to spend money on those expenses. This is a way to do it tax free. There's a lot of rules associated with HSAs if not used for health related expenses. I'm not going to get into all the nuances of that right now, but it's a fantastic strategy to use if it makes sense for your situation. For some people who have high prescription costs, limited cash flow, maybe they see the doctors monthly for different types of visits. An HSA may not be the best type of plan for them. So we always tell individuals, look to see what's important for you, what your family needs, and for two individuals working, compare your health insurance plans available. Don't just look at the difference in premiums, look to see if there's an HSA and if the employer is matching into it like a 401k, because then that's free money. Or maybe you work for an employer that will give you a credit if you don't allow your spouse to jump on the health insurance. So that was something we saw a few years ago through the Healthcare Affordability Act was more and more employers incentivizing their employees not to do a family plan, and they were basically giving them money to incentivize to do that. So it is important to take a look at all your benefits and then compare them with what your spouse may have too.
That's great. And what happens if you change employers, Lena? What happens to those health savings accounts?
Great question. So you have a couple of options. You don't have to do anything. You can keep that money where it is. The one thing that I tell individuals though is depending on the amount that's in there, it may not be advantageous to keep it there. So let's say you only had $500 in there because you didn't spend a lot of time contributing to it, or you weren't with that employer for a long time. Use that on health related expenses so you don't get hit with maintenance expenses that the HSA may start to incur on your plan. Or if your new provider has an HSA, you can roll that HSA directly to your new plan. And you can have as many HSAs that you'd like. We try to tell individuals consolidate as much as you can. It helps from a diversification standpoint and it helps to minimize costs, but you're not forced to take any distributions from the HSA.
Right. Thanks. All right, let's talk about long-term care insurance. And this is not typically found in benefits that we're seeing. So this is something that individuals do have to go out there and shop for themselves. And this is typically care that's going to be for aging clients that can't perform certain activities of daily living. They're in a nursing home or assisted living. But this is a space that's quickly changing and evolving, and there are lots of ways to fund long term care insurance. So why don't we spend some time talking about that?
Sure. So for long-term care insurance, I looked it up because I was curious if the numbers changed. But the average stay for a nursing home is 1.5 years, which basically says, typically when you go into a nursing home, unfortunately, not coming out. But that time you're there can be extremely expensive. And we're just talking about the financial side. There's obviously a lot of emotional aspects when a spouse or a loved one is in that situation. But the national average for a private home and a nursing home is just shy of $10,000 a month. So, one of the misconceptions is it's not covered by Medicare. Most people think, well, I have Medicare insurance. That will cover me if I need to go into a nursing home or assisted living or adult daycare. And that's quite honestly not the case. So, having the insurance, if again it makes sense for you, could be able to pay for that benefit. For some individuals, they elect to self insure. And self insure means that they're going to pay for it on their own. So that may mean that they're going to tap into their assets, tap into their portfolio, cause taxable events. They could be significant taxable events depending on the tax laws that are in place at the point in time to be able to pay for these expenses. And so, for a lot of clients that will say, I'm not paying on this insurance, we have enough money, we're just going to take care of it on our own. The issue is when spouses have to go in together, right? For some people, they can afford when one person goes into a nursing home. But if both have some type of nursing home need, one person may have already spent down some of that money. And then there's really nothing left from an inheritance perspective if that's important for individuals as well. So I think, Claudia, you and I can both agree. We probably have majority of clients that will say, one, I can either self-insure, or two, ah, just I'll, put me in the backyard or something. I'm never going into a nursing home. And the problem is usually you don't know that you need to go into a nursing home when it's time for that to happen. So there's insurance in place, insurance available for just these things. So again, personal story. When my grandmother had to go into a nursing home, they did not have a lot of money. So both my mom and my uncle had to pay this bill. And as I had said to my mom, when we planned for their retirement, we didn't plan on her having to support her mother. So she was really limited in the quality of care that they could go to because they could not afford a lot. And I could tell you it was not good quality of care. And so sometimes having that insurance, even though you can self insure, having that insurance gives you that opportunity for more flexibility in the quality of care. But I remember every time my mom went to go visit my grandmother, she would then call me and say, would our insurance policy cover this? Because my parents have long term care insurance. And they would ask me, would it cover this? Would it cover that? Because she was seeing everything that her mother was going through. So, unfortunately, it's not until you're in that situation when you really start thinking about it. And for a lot of individuals, they should start thinking about this in like early 50s is the ideal time to start that conversation.
That's great. Sarah, if we could go to the next slide, let's talk about the different types of long-term care insurance and the cost, because I think you make a good point. A lot of people either see the cost of long-term care insurance or see the assets in their portfolio and choose to not go the traditional long-term care insurance route. But things are evolving, and there are ways for couples to take advantage of maybe shared benefits, for example, or ways to mitigate the cost of the long-term care premiums as people are aging and the costs go up. Or maybe even something as simple as like annuities that we use to help offset some of the cost, but maybe not all of it. So why don't you take a few minutes and talk about some of those options?
Sure. So on this slide here, where it says hybrid life and long-term care policies, a few years ago, probably more than 10 years ago at this point, life insurance companies got, or I'd say long-term care companies got, pretty smart because the biggest issue and the biggest, uh, I would say, frustrating point that a lot of clients had with long-term care insurance is, what if I never need it? What if I just pass away in my sleep? What if I get into a car accident and pass away? And I never needed this long term care insurance. And that's correct. There were policies, and there still are policies that are just for long term care insurance, doesn't pay for anything else. It's kind of like your auto insurance. If you never get into an accident, most insurance companies aren't going to pay you back all of your premiums or give you some type of significant benefit. And with these long term care policies, you had to pay on it for the rest of your life. So it could get very expensive, especially when the insurance company keeps increasing the premium. However, the benefit to these policies is that they tend to be less expensive than what's called a hybrid policy. So the insurance companies got smart and they said, what if we wrapped a life insurance and a long term care policy together to create a hybrid? This way, people are going to use it for one thing or another. They're either going to use it for nursing expenses or they're going to pass away and there'll be a death benefit that will come out. So, individuals started purchasing long-term care policies, started purchasing these hybrid policies more and more because they knew there would always be something that would come back to their spouse or to their heirs. The disadvantage with these types of policies, they tend to be more expensive because you're wrapping, a couple of benefits in one. But for many individuals, it makes a lot of sense to do it that way. You have structure around your premiums because you're not paying on them for the rest of your life. You could do what's called a single pay. So you just put the money in the policy of one shot and you have this, or you could do it over 10 years, 20 years, etc. So you have some flexibility within your premium structure. The other thing that you mentioned, Claudia, has to do with annuities. So, not really wanting to go down kind of an investment conversation, but when we think about self funding and using your portfolio, you could structure your portfolio to incorporate an annuity, which is an insurance product that has some type of long term care benefit. So there's a lot of annuity carriers out there that have what's called an income benefit that helps to provide additional income for you when you are retired. But in the event that you qualify for some type of long term care need, then that benefit could double or it could increase in some way to give you additional income to help to pay for that long term care need. Now, I think it's important to understand when I say to qualify, you have to fail to activities of daily living. So, activities of daily living are traditionally transferring, toileting, eating, changing, walking, things like that. So, if you can't do two of those activities, chances are you'll qualify for some type of long-term care insurance. That will pay out. And I know we're going to talk about disability insurance in a little bit, but disability insurance is different than long-term care insurance. So long-term care insurance is paying for you to go to a nursing home. It's paying for any of those costs associated with assisted living, or it's paying for somebody to come into your house and take care of you. What a lot of people also don't understand is that those policies can also pay for somebody to come and help you go grocery shopping, somebody to come in, help to clean the house, or you have to put in an elevator in your house. You have to put in a chair lift. You have to redo the outside for a walkway. You have to put in handrails in a shower. The policies can also pay for that too. So even though we can self insure, we can self fund, sometimes it's more economical to pay for the insurance policy to help to take care of all of those items.
That's great. Yeah, with people aging and living longer, this is unfortunately one of the areas where we are seeing people use their policies to some extent than not. So definitely something to consider. And if there are any questions, we'll take them after. after we wrap up here. But let's switch gears and talk about disability. So, disability comes into play if you're still working. So unlike long-term care insurance, when you're likely retired, disability is going to protect you if you're unable to work, either permanently or temporarily. So why don't you kind of walk us through? I think that the biggest thing is people understanding what benefits are available to them. Some people have the option to buy up a benefit, but depending on somebody's needs, that may not be enough what your employer provides for you. So how do people go about getting the right amount of disability insurance if it's not provided through their employer?
Yeah, so if we're looking at basically self-insuring, then you're going out to what we call the marketplace. You're talking to an insurance agent and looking at getting a separate disability policy. And what they'll do is the insurance company will look to see, well, what is your job? What would be considered a disability? So, as an example, a surgeon who's using their hands a lot, if they break both of their hands, then they're not going to be able to perform that surgery. So they would be considered disabled. But what if they broke one hand? Could they still do the surgery? Or what if they broke their legs? So you want to make sure that when you're getting a policy on your own, you understand the definition of disability and how it applies to your job. And if you change your job over time, how does that disability policy carry with you? For the insurance policies that we do see through the employers, which is, I'd say, the majority of individuals who have an employer, they're not a business owner, they're not self employed, and they have their own disability insurance where they have it through their employer. There's two types of disability. There's short-term disability and there's long-term disability. So short-term is exactly how it sounds. Short-term disability typically lasts a few months. Long-term, it's usually all the way up until, usually 65 is the magic number. Some plans, it can be a little longer. And Claudia, you mentioned about buying up. When we're looking at employee benefit plans, we'll point out to a client if they have the opportunity to buy up that insurance. And we'll typically recommend that they do because these disability plans don't provide 100% replacement. So you may want to have a private plan to coordinate with your employer plan. There's a lot of strategies that we leverage for residents in medical school because their income ability hasn't really kicked in yet. And they're able to get some private plans first. And then once they start working for, let's say, a hospital or a practice, we can then coordinate that group plan with the private plan. So for a lot of residents, we may look at those options. A lot of people tend to not elect the short term disability because they think, well, I don't need it or I'm not going to get sick. And, the two biggest areas that I see the need for people to have it, which as a female I find amusing, is pregnancy is considered short term disability because I guess we are considered disabled when we get pregnant and have a baby. So for some women who are planning on having a baby, make sure you have that disability in place. Make sure you understand the maternity leave because you can coordinate all of those benefits together. For the past few years, we've had COVID and people have gotten significantly sick and out of work. So, making sure that you have that short term disability in place would cover illnesses that last for a few months. So, again, you want to make sure that you understand the definition of disability, what your employer is covering, and for how long. And if for any reason you don't have these plans available or you can't afford those plans, make sure that you have emergency reserves set up in the event that you become disabled in any way.
All right. And what about people that are self-employed, that are starting their own business? Are they eligible to get disability insurance?
Absolutely. I would say everybody's eligible to apply for disability insurance. And traditionally, for self employed individuals, they tend to look at the last 2 years of your tax return to get an understanding of what your income has been. So, for somebody who may be just starting out, they're not going to receive a lot of disability insurance that they could apply for. So, you want to make sure that there's a cost of living adjustment added on there or there's income increasement that's added on there where every 2 years you submit the most recent tax return. So you get the bump in income benefits on your disability. And then you would want to talk to your CPA, your accountant, on if you should deduct those premiums or not. So there's pros and cons to deducting the premiums on your disability insurance, because if you deduct them now and you have some type of disability event down the road, it will be taxable income to you versus not deducting the premium right now. That disability income will actually be tax free.
Right. Thanks, Lena. All right, let's talk about something a little different now. Let's talk about the property insurance. So, different types of property insurance here. I think we're going to focus on auto insurance first. So, I think this is an area where I get comments, mostly from other advisors that ask, why are you talking to people about their auto insurance, or why are you talking to people about their homeowners insurance? And a lot of times it's the asset that people use the most, or in most cases, it might be a significant portion of their assets. And also liability, an important part here. So why don't we focus on auto insurance? I think I know what people I think people know what it is, but why do we as advisors focus on this, and what do we try to make sure that clients are covered?
I think as advisors, we focus on all areas of insurance because we want to make sure that the assets are protected, right? So we may use the comment in the office. We want to put the moat around the castle. We want to be able to protect everything that you have. And auto insurance is one of the big ones to where people get sued. So you have a car accident, you don't have enough coverage, or the person that's involved with you doesn't have enough coverage. Guess what? You're coming out of pocket, which means you're tapping into those assets again. And that can be extremely stressful. It could be tax impact. There could be a lot of issues surrounding that. So, auto insurance is an area that we want to take a look at. One, to make sure that they have appropriate coverage. So, in the event there is something that happens, they're protected. And two, as we've seen, I'd say over the past 12 months, premiums are jumping up on a significant rate for both auto and home insurance. So understanding the policy that they have to see, are there any other discounts? Should we change any deductibles? Is there anything else we should be doing to help to kind of maintain a certain premium based upon cash flow? That's why we would want to be able to look at it. As a mother of a teen driver, it's another aspect of making sure that when you think about trying to get discounts, making sure you're submitting those report cards for the good student discount. And when you're retired, to notify your insurance company that you're not doing the driving that you once used to do. You're not doing the commuting that you once used to do. So by updating your driving information, that can also save some premiums. I just had an issue with a client the other day to where the husband is no longer driving due to some health issues. So contacting the insurance company and just getting him off the policy because he's no longer driving could potentially save some money as well. So the auto insurance is a big one that we'll spend time with clients and take a look at. And sometimes we'll hop on the phone with them and State Farm or USAA or Geico to kind of walk through any adjustments that we may recommend.
That's great, Sarah. And if you could just pause on the next slide for a second, there are all the factors that affect the premiums, because these are the things that we do talk about. And like you said, if you have teenage drivers in the home, you're probably not saving a lot of money on your premiums right now. But it's important to keep the insurance companies updated with the changes and who's driving and whether or not they're still at home, because all of these factors could cost you or save you some money. And then when we look at coverage limits, let's kind of tie that in with the homeowner's policy, because a lot of times, especially when we look at liability, you could maybe increase some of the limits on one policy, decrease them on another. But let's talk about how the homeowners is structured, and then how they're related. So Sarah, if you could go to the next slide. So Lena, I'll kind of let you just take us here. Just homeowners. If you own a house, what are you trying to protect? And if you're a renter, why do you need insurance if you don't own the property?
Mhm. So I'll start with the rental policy. So if I have an apartment, I'm going to have all my furnishings in the apartment. I'm going to have my clothes. I may have TV, I'm going to have my computer, I'm going to have jewelry. I have things that are very important to me that if I lose through a flood because the bathroom with the tenant upstairs leaked and ruined all my stuff, I want to replace. Or if there's a fire or a break in, I want to make sure my household items are taken care of. And that's how most people think about it, but they don't think that you can actually have renters insurance. And they think that the apartment complex or the landlord, if you're running a townhouse or a single family home, that their insurance is going to cover your property. It doesn't. You need to have a separate policy for that. So we always recommend that renter policy, and then we'll take a look at it to make sure it's covering the things that you want. Homeowners policy, I never knew how much I would rely on my homeowner's policy until about 10 years ago. We had a major flood in our house. We went on vacation, and my kids had used the bathroom right before we hopped in the 8-hour drive. And within the toilet, some of the plumbing broke. And so the toilet kept running and then flooded the entire house, or about 80% of the house. So, I will give a major shout out to State Farm because they were able to take care of basically relocating us to where we needed to live for 9 months before while our house was rebuilt. I had to create an inventory of everything in our house that would have to get replaced. Now, if we all think about our house and you just pick one room, I guarantee you can't remember every little thing in that house. So, since then, a few things that I've learned is every few years, take your cell phone, put it on video, walk around your house and film everything in there and then store it in the cloud. That way, if something should ever happen, something gets damaged, you will have inventory, you will have video that you can furnish to show what needed to be replaced, whether it was a little $10 frame from Target or the $3,000 TV. What we also learned was, and this was kind of conversation in dealing with other individuals who have had some serious damage to their house, was all of your belongings that may be really important, like papers, passports, things like that, that you keep in a safe, that you want to put those documents in Ziploc bags because even though it's fireproof, it may not be protected from water damage from the fire hoses that are coming through to, put out the fires and everything. So you want to make sure when thinking about you having to process claims to be able to protect those belongings. These are just a few little things to kind of keep in mind, but I know I kind of went on a tangent, Claudia, so my apologies. But the homeowner's policy, it's designed to do exactly that, protect against damage to both the structure as well as all the belongings that are in that property.
That's great. And Sarah, if you could go to the next slide, you mentioned in your story there a couple different things that maybe aren't necessarily covered just under the basic homeowners insurance policy. So folks that live in certain areas might need to add some additional coverages. Why don't you touch on some of those that are listed here?
Sure. So flood insurance we see quite a bit in areas where they're right on the water, they're in flood zones, and those could be required. And you don't have a choice. And there's significant premiums. So when you're thinking about getting that house on the beach, make sure you take a look at, okay, well, how much in insurance is that going to cost me? Same thing with earthquake insurance. Earthquake, you're going to see more in certain areas, just like the flood insurance. It's not going to be, um, you know, we're in Maryland right now. We've had earthquakes. It's not something I've ever actually considered, but if that becomes more of the norm, that may be something that we start looking at as earthquake insurance because if something happens in our house where we have damage, but it's because of an earthquake, I may not be able to get as much of that claim paid out if I don't have that policy because my existing policy may exclude earthquakes. That's where I may need a supplemental plan. And what's extremely common is the valuables rider. So anything that you have that you will miss and want to replace in your house if it was ever damaged or stolen. That's what you want to have a separate rider for. So traditionally, your homeowner's policy covers up to a certain amount of personal property. But if you have like an engagement ring, a wedding ring, collectibles, family heirlooms, baseball card collection, sports memorabilia, guns, things like that, artwork, you want to make sure that you get everything appraised and then have a separate policy for that. We've had situations to where wedding rings have gotten lost. You're out golfing or you're in the ocean. And if they're insured, it's a very easy claim to submit and replace that ring. And then sometimes you
Yeah.
can upgrade it too.
Yeah. Yeah, there's a lot of things you can assure against. I'll throw out there if you own a home, sewage coverage. If there's a water main break, a lot of times there's a portion in your yard that is not covered. If they need to go in and dig in to fix a pipe or a sewer, and you'll have to repair that on your own. So, a lot of coverages out there that are inexpensive, but just kind of smart to have in case the unexpected happens.
Right.
So let's wrap up the property and casualty discussion, talking about the umbrella coverage. Um, Walk us through what umbrella coverage is and how that's different, or how it supports the other insurance that we just talked about.
So, umbrella insurance is additional lines of liability to cover your auto and your home. Traditionally, you have to have the auto and the home with the same insurance company. That's what they prefer. It's in $1 million increments. And traditionally, it's about $175 a year. However, if you have teenage drivers, it is much more than $175 a year because they're risky drivers. Um, Traditionally, we recommend getting enough of insurance to protect the net worth. So if somebody's net worth is $4 million, we're going to recommend a $4 million umbrella policy, because if there's some type of lawsuit, damage, etc., that exceeds your existing liability coverage through the home or the auto, depending on where the issue occurred, you're going to have to go into those assets. You're impacting your long-term needs. That's why we want to take a look at the net worth for individuals. That I would say, I'll use the example for doctors. If people find out that they just got into an accident with a doctor, they may think there's a lot of dollar signs attached to the doctor, so they may tend to sue, because a lot of people sue these days for anything. The umbrella policy could potentially protect that as well. So it is an important level of coverage. However, two things that are important to remember: if you have teenage drivers, premium is going to go up. And number two, traditionally, you need to have the auto and the home with the same insurance company. So if you have them separate right now, you may want to have a conversation about consolidating them.
Great. Thanks, Lena. All right, let's talk about some of the other more fun insurance that we're starting to see these days. We'll call them specialty insurance, but I think the first one on there is pet insurance. I know we have a few clients that have that covered. I've even seen it as an employee benefit, for some clients as well. So why don't you walk us through some of these and when we might want to consider?
Yeah, these are, as you mentioned, with employer provided plans, we're seeing more and more employers offering some of these types of options for insurance. So, pet insurance is, if for those of you out there who have pets, cats, dogs, etc., you know how expensive it is. If they need a procedure, they go in for a visit, and something happens to them. So, for pet insurance, what I'd recommend is talk to your vet to see if do they even take insurance, because some vets don't, and it would be pointless for you to pay for the insurance and then find out that your vet does not take it. So talk to your vet first, see do they take it, and then what does it typically cover, and then you just kind of go from there. Sometimes the animals that you get from the shelter, you don't know their health history or anything. That may be a time when you want to be able to have that pet insurance. Travel insurance has comes under, I would say, a lot of scrutiny, just because you have to make sure that you understand all the rules on when you need to file that claim. So I always tell individuals, if there's a chance that you think you're going to cancel your travel plans because maybe somebody is not doing well health wise, and you don't know if you would have to cancel from that perspective, or there's some things happening at work, maybe there's a chance you'd have to cancel, then purchase the travel insurance. But there are a lot of rules to follow. So make sure you understand what all those rules are, because they've gotten to be pretty tight if you have to cancel your travel plans because of airline issues or because of threats of terrorism. COVID is now an exemption in a lot of policies. So just be mindful of that. Identity theft protection is huge. We recommend this all the time and looking at whether it's credit monitoring, identity theft protection, and making sure that, and this you can also have on your homeowner's insurance policy. A lot of insurance companies have this as an add-on. It's usually about $10 a year is what it costs, but it can help to reimburse you for expenses incurred due to identity theft. So that's one, I would definitely have you take a look at. And then business insurance, again, if you're an entrepreneur, you're self-employed, and you want to have some professional liability insurance or business insurance based upon your plan, that's something that's super important. So, self employed individuals, the exciting thing for those individuals, business owners, is you get to kind of craft your own policies, whether it's the disability side, the health insurance side, but also various types of businesses, key man insurance. I mean, you can get pretty fancy with the different types of insurances out there on the business side, and we'll probably have a whole separate webinar catered just towards business owners, which we'll pull Yanni in on that one.
That's right. It'll be his turn.
Right.
Great.
Put him in the hot seat.
Well, we covered a lot of different insurance types, and I think certainly it's a lot for people to think about. But when people are thinking about insurance coverage and what to prioritize, it's not always going to be easy to kind of fill all of the insurance buckets, nor may people need to fill all of the insurance buckets. So, in closing, why don't you just give us a couple pointers for how people should go about thinking about insurance, and making that assessment and making the decisions.
I think that the main question to ask yourself is, where is your greatest financial risk? Is it in the loss of your income? Is it the loss of a spouse? Is it in the event you get sick? Where's your greatest financial risk? And by doing that, that's what will help you to identify where your needs are, what you can afford. I'm just going to say this one comment. I forgot to say it on the life insurance side. One of the biggest misconceptions, especially for non-working spouses, spouses that may be staying home with the kids and everything, typically don't have life insurance, and they need life insurance because in the event they pass away, somebody needs to still take care of running the house, taking care of the kids. You may have to leverage daycare expenses now. So that's one area where we see a lot of people underinsured. So you have to determine where's our biggest financial risk right now, and then you go from there. I think it's super important to work with the certified financial planner or a licensed insurance agent, and they're talking about all of these things together. Not every insurance policy is right for everybody.
Great. Thanks, Lena. Well, with that, I think that gets us to the end of our topic here. But Sarah, do we have any questions out there from the audience?
We do. So somebody did ask us to kind of jump back over to life insurance. And I know we kind of skipped over these different types. So if we could do a quick overview on what these types of life insurance are.
Sure. So term life, on the term life side, you're paying for a fixed amount of years and your premium is level. So let's say, for example, you chose a 30-year term life insurance policy. You have that insurance for 30 years, you have that same premium. It's a level death benefit. And it tends to be your least expensive type of life insurance. So it can be used for certain needs based upon that client's goals. And at the end of those 30 years, traditionally the premium skyrockets, so you usually cancel the policy, and the idea is you don't need the term insurance at the end of that time period. Universal life, whole life, and variable life are all similar from the standpoint that there can be some type of cash value that's associated to it. Universal life traditionally doesn't have a lot of cash value built up, but it has flexible premiums and coverage. So if we want to have a more permanent policy, but we're trying to keep the premiums down low, and I don't need to build up some cash value, I can use the universal life. Whole life is your more traditional permanent policy. tends to be a little bit more expensive than a universal policy. That cash value can be used for a lot of basically any type of expenses you need. I briefly mentioned it about buying a house, starting a business. There's ways to which you can access that cash value in a tax efficient manner. And then variable life is not traditionally a permanent policy, but it could be if used properly. There's more an investment piece that's added on there. And it's important to make sure you're reviewing that policy annually. A lot of people, unfortunately, that have these policies don't take a look at them regularly. So they don't rebalance the portfolio that's within that variable life policy. And that cash value projection may not be living up to what it needs to do to support the life insurance and could actually cause it to lapse. So variable policies tend to be more expensive, but they're also one where you have to really pay attention to on that allocation and make sure that you're adjusting the allocation based upon the insurance premiums, based upon what the market's doing in the investments, et cetera.
Thank
With
you. Was there something to add to that?
Oh, no, go ahead.
Um, I'll jump back in the slides, but talking about insurance for business owners, this might be more of a lawyer question, but how does that insurance differ from the protections you get when you own an LLC?
Yeah, Claudia, did you wanna take that one?
Yeah, I mean, sure. I think within business, business owner business insurance, there are different ways to protect the business entity. An LLC typically is going to be a pass through entity, meaning that it does pass through to the individual's tax return. The liability is limited, but a lot of times it is closely tied to the individual. When we're looking at more traditional business structures, there are various ways to use insurance there. You could do buy sell agreements to protect partners. You could have insurance in place, for key man life insurance to protect a certain person in the business. So there are different ways that they can be used for business owners, whereas an LLC owner, it kind of depends on the stage of the business, whether you want to protect that individual. They may still be looking at traditional disability insurance to protect income, or traditional life insurance to protect some of their heirs. But Lena, if you want to add anything to that.
Yeah, the only thing I'd add to that, I agree with everything you said. I would just add that that's the conversation that we like to have in incorporating the accountant and the business attorney in place too, to make sure that we're not missing any deductions. We have all the operating agreements in place. There's been a lot of changes in the tax laws over the past few years regarding LLCs, and how we can leverage certain policies. So it's really good to incorporate all your professional advisors in those types of conversations.
Awesome. And I think we have time for one more quick question. I know I can relate to this question living in Austin, Texas, where we get a lot of hailstorms. Um, with homeowners insurance, there can still be a pretty big out of pocket deductible. What is a normal like expense that you can expect when it comes to deductibles with homeowners insurance?
Yep. So I would say this is going to vary depending on how much insurance you have, how big is your property, as an example. But it would be, I would say, anywhere from about $500 to $2,000 is where you would see your deductible. I don't know if Claudia, if you have a different opinion on that. But the thing that, you got to keep in mind, even though you can increase your deductible to minimize that premium, you want to make sure that you actually have the money in the bank to be able to pay that deductible. Okay. And if you don't have that money in the bank to pay the deductible, it may make sense to keep that deductible a little bit lower. So, Sarah, as you mentioned, if you feel like, oh my gosh, I keep having to get hail damage and everything, maybe you have a lower deductible because you feel like you're using that policy more. And that deductible is carried through the course of the year. So if you had multiple claims, you only have to pay that deductible one time until that year starts over, and then you're basically at square one on the deductible. So I don't know if Claudia, you had anything that you wanted to add to that.
No, I think that's spot on, and also just to keep in mind that, they are looking at how many claims you file, and so, typically use your homeowner's insurance for the big things. It's the flooded basement, it's the hail damage to the the shingles on your roof. It's not necessarily a cracked window that you can maybe pay for from cash flow. So just
Right.
keep that in mind, and obviously consult your insurance professional or your advisor to help kind of work through those decisions as well.
All right. Well, this was the next webinar that we have. So we have a QR code here if you wanted to register for the next webinar. Claudia and I have quite a few items coming up this year on webinars. You can go check out our history also, as far as some of the other programs that we've done. I think on our BFG library, we have additional resources regarding podcasts and some webinars and some ebooks regarding some of the things that we've talked about. But this is our next webinar that we're going to be hosting. And I think that's all we have. So Claudia, you were easy on me today. I appreciate that.
Yeah, not too bad. Thanks everybody for joining us, and we look forward to seeing you on the next one.